Good afternoon. Thanks for joining us for today's webinar. I'm Mitchell Lewis, President and founder of Fetch Freight. Today's webinar will be focused on understanding the current shifts in the freight market and helping you make sense of what's ahead. We'll cover what's happening now, what's likely coming in the year ahead, and how you can use this information to strengthen your strategy for 2026. Today, I have with me Brett Lankford, our Director of Strategy here at Fetch Freight.
Thanks for having me.
And Brett's background spans both sides of the freight world. He was first with major 3PLs, then leading transportation strategy for ConAgra Brands and Campbell Soup Company. He helps lead our team as we broker shipments for many of our enterprise customers and crafting solutions for the local and regional businesses as well. Fetch is based here in Birmingham, and we're proud to have recently been named one of Inc.'s fastest growing brokerages in the country. Also, we're glad to have Tim Denoyer with us again. And Tim, we're thankful for ACT's research in this annual webinar. It's been hugely beneficial to us and hopefully to our customers and carriers as well. So Tim is Vice President and Senior Analyst with ACT Research. He is the primary author of the ACT Freight Forecast, which provides supply chain professionals with better visibility on the future of pricing and volume in transportation. Tim, glad you're here. We appreciate you being with us today.
Thanks for having me. Great to be with you.
As I said, we're just grateful for your partnership, and we thank you for joining us each year to review this ever-changing freight market. So, and to those tuning in, we're hopeful today's conversation is informative and helpful as you prepare for the year ahead. As I just said, we're here to review the current state of freight and the forecast going into 2026. But before we get there, we'll take a look at our current supply and demand conditions and discuss how each will ultimately impact our 2026 forecast. We'll talk about Class 8 truck orders, CDL issuance, and the impacts of policy decisions, driver availability, and we'll take a deeper look at the Cass Freight Index, and then we'll look at forecasts for the coming year. We'll save some time for Q&A at the end. So just as a quick reminder that if you have any questions throughout our discussion, please use the chat feature and we'll cover those towards the end of today's conversation. So please just submit those questions and we'll do our best to get to them here at the end. So, we'll start off by just looking at the supply conditions. And Tim, I think this is going to be your area of expertise, but really just the Class 8 truck orders. And this chart it just really highlights the dramatic slide in truck orders over the last 3 years in response to weakening market conditions. And from the looks of it, we're not expecting much of a change as we move into 26. So Tim, can you kind of walk us through what we're seeing here and the thoughts behind this supply side forecast?
Yeah, that's right. I think it's a really interesting time on the supply side. If you look at the blue bar across the middle of this chart, it's basically replacement demand. We don't have it really labeled there, but we need something like 150,000 new Class 8 tractors each year just to sustain the fleet. And that number is going up because the fleet's been growing for quite some time. And at the same time, we've had the 6 months of the worst truck orders since 2009. So we've heard some of the manufacturers are only offering pricing through the first quarter of the year. I think there's still negotiations going on to get some of these tariffs reduced. The tariffs that are really hitting Class 8 tractors are not the IEEPA ones that are under the Supreme Court challenge right now. They're Section 232, so that's on firmer legal ground, and it's going to be tougher to get them legally rolled back. But I believe there are some pretty hard negotiations going on behind the scenes, and so still a fair amount of uncertainty if you're a fleet planner. We did get one pretty significant piece of news just a few days ago. The ATA, the American Trucking Associations, released a comment that they had spoken with EPA recently. We don't have an official pronouncement from EPA yet about the 2027 low NOx regulations, but as they're written, it would push the price of equipment up quite a bit, and would probably motivate some pre-buying, which would suggests that our forecast is a little too low. But we are hearing that they're going to revise the low NOx rules. We've been suggesting for a while. We'll end up at sort of a middle way, which isn't the full cost of the rule as it's written, but it's also not delaying the rule altogether for 4 years, as ATA requested. But even they said that that's unlikely. We're probably going to stay at 35 milligrams of NOx for the rule, which is the way it's written now, but remove the costly warranty and useful life provisions. And so that takes the costs from like $25,000 way down, takes out the vast majority, probably over half of the costs go away, maybe three-quarters. I don't know. It's hard to know. But that's where most of the cost was, and these pretty significant warranty and useful life provisions. It does look like EPA is going to get rid of those. They don't think they said that they're probably not going to make an official pronouncement until March or April. So it's going to be a while until we know. That probably will drive that little uptick that you see there at the end part of 2026. Could it be a little bit higher potentially? But to take a step back and say, what does this mean for freight markets? The important point is that even though there was a bit of a spike here in 2025 on pre-tariff equipment purchasing, 2025 sales are going to be below consensus, below replacement by about 15,000. And so we are starting to take equipment out of the fleet. And then if you look at our forecast for next year, we're going to take something like 50,000 tractors out of the population on the current demand outlook. And while I do hedge a little bit by saying there could be some upside later in the year, I think the near-term trends could be even a little bit softer. So feel pretty good about that 50,000 coming out next year on top of 15 this year. And it probably isn't going to get back to growth in 27 either. So we've got a few years of capacity contraction ahead of us.
Tim, so just so I understand, at the end of 26, the way that we're looking at it right now, that uptick is driven more from the EPA regulations and not so much from a market-driven recovery. It's just a response to the EPA regulations as is forecasted right now.
It's a little of both, for sure. But I think the recovery in freight is not likely to be too strong or too fast, and I think it's going to take a little while to flow into truck sales. I think it's really going to be mid-year next year before we see any real traction, and that could lead to some ordering kind of the third and fourth quarter of 26, and those sales coming through in 27. Although those new trucks in 27 are going to have the new, more expensive and more complex engines, and so there's going to be some reticence to buy those too. So there might be a little bit more of a pop at the end of 26 before 27, but there's a likely contraction of capacity going into 27 too.
Yeah. Okay. Great.
Hey, Tim, I've got a question for you just on this. This kind of stood out to me when I first saw this chart in the latest report that came out. But if you look at 25 and 26, we get a little bit of the head fake, the spike in the middle of this year in 25. But outside of that, if you strip that out, you've got basically 2 years, between this year and next year forecasted below replacement levels. And even looking back on the timeline of this chart, going back to 2014, looks like maybe the longest stretch below replacement levels in quite some time. What I'm wondering is, if there is even a modest recovery in demand in 26 and 27, could this be teeing up a potential capacity crunch on the truck side, possibly in 2 years?
Yeah, I think that's a great question. I think that's a great read. I think at the moment, the cautious sort of advice is that I wouldn't get too excited, because if you still have to look back at 21 through 24 when we added more capacity than pretty much any time in history. So we're still working through some of that excess capacity, but we're working through it at a faster rate as sales drop below that blue line. So I think that acceleration does suggest that point where we get back to balance is within the next 6 to 9 months. It has felt that way for a couple of years, but then we continue to order more trucks and buy more trucks. So I guess I'm slightly concerned that just the certainty, if you can call it that, from what I just described from the EPA communicating with ATA, um, just a little bit more information about 27. I think maybe that could help, could drive some truck orders. If I'm a fleet planner, I'm going to probably, uh, get a few of those last 26 trucks probably. But on the short side of this thing, we're hearing about just really, really weak demand, and we track inventories as well. Inventory to sales ratios are correcting, but the anecdotes from the field suggest that there have been some orders that have been canceled, and some trucks are actually piling up on dealer lots for the first time in a while at the moment. And some of that is because of tariff costs that even before the Section 232. But yeah, it's a very interesting market balance. But the good news for carriers and brokers and that part of the for-hire sector is that this capacity tightening is really what we've sort of been waiting for the last couple of years. And it's been easy to say, oh, the upturn's coming, but I would suggest that this is probably some of the strongest evidence.
And Tim too, like, I mean, what you even just mentioned is that when the time comes, say it's 2027 for fleets to begin possibly expanding again or later, they're going to be dealing with two new factors on the cost front between the tariffs and, more expensive trucks that are emissions compliant with the new rules.
Absolutely. And let's not forget insurance costs. Insurance costs are still huge pressure on fleets these days. And the overall costs are just not letting up on fleets. And so we've heard some really ugly profit margins when you talk about some of the smaller and medium-sized carriers out there. And it's not just like they need a couple points of rate to get back to break even. It's like some of these guys are just operating at just crazy kind of levels. And so, that does open the possibility to some potentially higher rate increases if things really tighten up. I mean, I think we're still a long way from that, but I think there's still enough capacity out there. Our demand outlook in the next at least 6 to 12 months isn't wonderful. I know we'll get to that, but yeah, that's why this is definitely a longer term question. But I think there's definitely something to that.
That's perfect. Well, thanks. I think this is great context as we move forward, and as we look at it, just it's one of these charts where, like a lot of what we're going to be looking at today, it just depends on which side of the equation you operate in, and whether you're a shipper or a carrier. But this is information that some want to see, and others not so much. So we appreciate y'all each taking the time to break this down, and we're going to, I guess, moving forward, we can shift into some of the policy decisions and the driver regulations that have really been making some headlines over these last few months. And so, this one right here is just the first time I saw this one, it was just a really shocking picture. It really gives a clear visual of the capacity that has flooded the market over the last few years, and gives an idea of how this, a little bit of how this freight recession has lasted for so long. I think, we spent, it seems like, the people who, or the analysts and, people who are monitoring the freight markets have probably scratched their heads for probably it seems like the first, for 2023 and part of 24, trying to understand why did this recession last for so long? And, I look back and think to our webinar last year and in December. And Tim, I think, through conversation with you and the team at ACT, were some of the first ones to really kind of point to some of the at that point we talked, I think it was talking about immigration policy. That was a big talking point, but this one right here is kind of, we were first exposed to this in beginning of or sometime this summer. But I look back at our quote. I went back and looked at the webinar from last year, and this is a direct quote from our webinar. Said there's a lot of concern about abuse of B1 visas, And so there might be some increased enforcement around that. Speaking about, increased enforcement in the year ahead. And, that's a direct quote from the webinar last year. And it's really, I think it, was the tip of the iceberg. So I don't think many people were even talking about that yet. So, Brett, this is one that I think you've really broken down a lot. If you can kind of walk us through this slide and, tell everyone else exactly what we're looking at here.
Yeah. Before I jump into this, one really big topic that's been in the news has been English language proficiency. But one that's now starting to come out more and more, it hasn't gotten quite as much airtime as ELP, but is the concept of non-domiciled CDLs. And if you go around the room, when you're talking with people in the industry, like many have not even been exposed to that, heard of that. We did see, some rule changes that affected this. I'm about to jump into those from the FMCSA back in September. But I want to start with this. What is a non-domiciled CDL, just for everybody that's listening? And this is the FMCSA's definition of this, is that basically it's a CDL that's issued by states that falls under one of two categories. An individual domiciled in a foreign country, so a foreign national who is living in the United States and pursues a U.S. CDL, and then also individuals who are domiciled in other states who are unable to issue CDLs for whatever reason. If that is decertification or something like that, which has never happened before, but there is a mechanism in place to enable those individuals to go seek CDLs in other states. This does, from a foreign national standpoint, I do want to call out, this does not apply to Mexican nationals or Canadian nationals. And that's because of our CDL reciprocity system with them. Mexican CDL holders, Canadian CDL holders, those truck drivers that bring in freight cross-border from Canada into the U.S. and back, and from Mexico into the U.S. and back, there is a program to facilitate that. So legally, Mexican and Canadian nationals are not actually eligible for non-domiciled CDLs, but all other foreign nationals are. So that is what a non-domiciled CDL is. It enables those individuals to procure a CDL. And then what I just mentioned is that there is a major rules change at the end of September, and the focus has been on legal immigration status. So I'm going to break down the old rules and the new rules really quickly for everybody. Under the old FMCSA rules, prior to the rules change in September, a valid work permit, a EAD, employment authorization document, was the basic requirement. There was no visa requirement. And this is just a legal concept to be aware of. There's a legal difference in work status, legal immigration status, and lawful entry. Those are three completely different legal concepts. So the old rules, primarily you needed an EAD, a work permit. Under the new rules, it's going to be focused more on legal immigration status and how you entered the country. So there's going to be a visa requirement. 3 visas are eligible to procure a non-domiciled CDL. An H-2A, which is for agricultural workers, H-2B, which is for temporary seasonal workers, and E-2s, which are treaty status, so treaty entities. And EADs alone is no longer sufficient, although it is required. Now also required is lawful admission and an I-94, basically an unexpired passport and visa status. Additionally, you have to pass the SAVE verification system. That's the Department of Homeland Security verification system. The CDL expirations must also align with your visa expiration or a maximum of 1 year, whichever is sooner. And then lastly, it is going to be only in-person issuance and renewal. So no more online renewals and things of that nature. So that is, again, it's going from work authorization to basically full legal status to be here, how you entered the country, and your ability to work will be required, which is a major change in just increasing just the requirements and able to be eligible for these non-domiciled CDLs. Now I want to jump into this graphic. What this graphic is showing you, first off, it was produced in partnership between the FMCSA and Reliance Partners. A gentleman named Tom Albrecht presented this just a few months ago at the Reliance conference. And I think, like Mitchell alluded to, is a kind of very shocking graphic, and I think really tells the story. I think the collective audience at that time had kind of their jaws on the floor. But here's how I'm going to walk you guys through this and just kind of what this tells you. So this is new CDL issuance to newly registered carriers. So that's new carriers since 2020. And it's focused on about 8 states and one territory, Puerto Rico, that essentially looking at the most recent year's data in 2024, those 8 states in Puerto Rico accounted for about 74% of these CDLs that we're looking at. So new CDLs issued to new carriers. And I want to mention one other thing about this data before diving in is that there's a lot of caveats to how this data is procured and what is available. It is state level. There's no single database that contains all this information. When I spoke with Tom Albrecht, he mentioned that they procured all this information from the individual states directly through Freedom of Information Act requests. Had to scrub it, compile it, and some caveats to it is that some states, just on the non-domiciled subject, some states keep a clear record of how many non-domicileds in particular they issue. Some states do not report on that. So there is a lot of nuance when you start looking at CDL data. There's not a national database, and they are issued just like our passenger car vehicle driver's license is issued by the states. So now kind of getting the data caveats out of the way, I want to break down just a couple years here. And I think, some of this really does make a lot of sense. If you start in 2021, think back to those times, market boom, rates are at all-time highs, historical highs, and you see this rapid increase in CDLs issued. So even looking at the very bottom row of this chart, 2020, 261 total CDLs issued in this category to new carriers, new CDLs. 2021, that number almost doubles to 463,000. So I think that really just depicts a lot of new, maybe first-time drivers, first-time carriers, maybe people pivoting from fleets and starting up their own operations. A lot of them entered into the market during that time, and it makes sense. It was market-driven. Just trying to take advantage of the really exceptional rates at that time. 22 and 23 also kind of makes sense. That's when the market started to correct. You had a really steep drop in rates, so unit economics started to turn unfavorable, and you saw a slowdown in the new CDL entrants for these new carriers. Kind of lines up with what you see in operating authority data too. Less MCs being issued during that time and things like that. So those all sort of align with what was going on in the market. But what became very peculiar is in this data set is what was happening in 2024, on a third year of really just poor freight market. You see a turnaround and a large increase in new CDLs issued in these states to these new carriers. So 74% of the CDLs that were issued to new carriers were driven by these 8 states in Puerto Rico. And when I see the Puerto Rico line, it's really, it's an exponential increase, possibly an outlier, possibly an anomaly. But when you look at something like that, it's that was a big question mark in the presentation. Is like how and why would Puerto Rico go from, call it 300 of these CDLs on average to 26,000 in 1 year? And I think a lot of this is still being sorted through. Much of these topics are just now starting to come up. And I think that this is becoming a big focus. We've seen and heard from other analysts in the industry, many have called this the smoking gun. I think that's yet to be seen. And I think also with the rules change, time will certainly tell. Now, one major last implication to throw in this is that the new FMCSA rules on non-domiciled CDL issuance that were put in place in September are now tied up in court. So that's going to take some time to work through. In the meantime, states are still allowed to issue non-domiciled CDLs, with the exception of some of the states that the FMCSA flagged and were put under corrective action plans. 2 or 3 of the states listed here were some of the states that were flagged: Texas, California, and I'm wanting to say possibly Illinois also was maybe the third one. But yeah, I think this is just really a stark image when you see this. And again, it's really hard. And this is not saying that these are all non-domiciled CDLs in particular. But one hypothesis is that much of this CDL growth, particularly in 2024, was in the non-domiciled category. And it's really hard to understand how many truly exist in the country. Like I said, there's caveats. The FMCSA estimates there's roughly around 200,000 active non-domiciled CDLs in the US, and that's out of 4 million active CDLs, roughly in the country. Some estimates are much lower. I've seen some estimates of 60,000. I've seen some as high as 400,000. So it's again, there's very little information truly behind the scenes that helps explain exactly what the composition is. But just reading between the lines, time will tell, particularly if the rules stand. You think about it, it's going to be a 2-year period that all of the non-domiciled CDLs will have to renew and go through this new process. It doesn't mean that it's going to take 2 years for it to fully resolve, but it will resolve throughout that 2-year period. If the rules stand. If they don't, then it'll be back to the drawing boards on, if that issue gets addressed in the same kind of manner. I just mentioned the one last thing is that with the non-domiciled CDLs, trucking labor and wages have kind of been predictable in nature. Fuel and labor costs are roughly around 60 to 80% of trucking OpEx, kind of depending on the fleet. If the way that we think of trucking wages is changing materially, then that could be influencing the length of the recovery. And again, I'm just trying to bring forward some hypotheses and theories that are out there in the market. Time will tell. There's very little information to go off of to take a hard stance on this issue. But I think everybody's seeking to try and understand how the market has dragged out this long. And perhaps this is a piece of that puzzle.
Great, thanks. And Tim, do you have anything to add to that? I know there's a lot, but love some input.
Yeah. No, thanks. I just, I'll just, pat us on the back again for a year ago, being ahead of this and saying enforcement was going to step up. I think it's evolved even more aggressively, I think, than we expected a year ago from an enforcement perspective. The out of service violations are up. We've only seen like 7,000 or so on the English language proficiency stuff, but we've already seen even before the non-domiciled rules were put under administrative stay. It's important to point that out too, that it wasn't a stay on the merits, it was just on the administrative piece. So it does suggest that the non-domiciled rules will take effect at some point. But even before that judge stated the rules, California found 17,000 non-domiciled CDLs with expired visas that they already canceled. So it has had an impact already. So I agree with your general estimates, Brett, that FMCSA said 200,000. They also said they thought about 25% of them were likely improperly issued. Maybe that 25% is low if we've already found 17,000. But we'll find out. And bottom line, I think it lines up pretty well with the contraction that we're expecting from a equipment capacity perspective.
Perfect. Hey, Tim, this may be a decent time to kind of wedge this in our conversation that we spoke just well, first I'll say, we were talking about the to some degree non-domiciled CDLs, immigration, some of those things this time last year, and I think we were on the front edge of things there. So before we hopped on our call this afternoon, you were pointing towards some ELD, some conversation about ELD. Is that something you think might be worth maybe giving us a little sneak peek at what we may, the storyline could be in 26 that nobody's talking about yet?
Yeah. So log toggling is the word. This is, I think, potentially the next big enforcement action. I think there's a lot of fraud happening. Yeah, frankly, this is an industry that sort of lends itself to some fraud. And before I actually get too far into this, as I look at these numbers that our buddy Tom had put together, like, it also smacks me that, like, that's where a lot of the fraud's happening.
Yeah.
But to come back to a different form of fraud, not CDL fraud, but ELD fraud, that's been a pretty significant problem too, and likely one of the factors that is dragging out this long downturn is that under the rules, the electronic logging device rules, the manufacturers get to self-certify. And that self-certification has allowed a lot of loopholes that are leading, that are essentially making it easier for fleets to cheat on their electronic logs. Instead of having to keep an entirely different set of paper logs, one to show the highway trooper and one that's real, you just have to switch back and forth between an app now. And essentially what I think might happen, I know some people who are pushing for the government to change the self-certification process on ELDs to a government certification process. If that were to happen, I think that could root out a fair amount of cheating on electronic logs and a lot of unsafe driving too. And when you're cheating on your logs, you're essentially putting the public at risk. So I think this is probably something that's a few points worth of capacity for the industry. I think it's a significant problem. And I think if they were to change improve the enforcement of ELDs, I think that could tighten capacity quite a bit.
And I think the big point that you made earlier today was it could happen very quickly if that were to be enforced. You know what I mean? So that's definitely something to keep an eye on. And honestly, if you'd asked me 6 months ago if we would have if FMCSA would have done anything as drastic as the non-domiciled CDL regulations that they put forth, I would have be one of those things that people would be like, yeah, they should do it, but nobody would ever do anything that drastic that quickly. But we've seen that they will. So definitely something for us to keep an eye on. But that takes us over to the again, our last a big part of our conversation is we look into 26 is going to be supply conditions. So this is ACT's for-hire driver availability index, and it really gives us a clear sense of how driver capacity is tightening or loosening across the country. So if you could just Tim, take us through this graph. It's proprietary to ACT. We always like to look at this in our webinars with you guys. So if you just help unpack what we're seeing here. And, I think there was maybe a little bit of a surprise in the most recent reading, but we've kind of seen some of these anomalies in the past and they kind of end up back on the trend line afterwards. So what do you see here and what do you think we might expect to see in the coming months?
Yeah, this is I think this is a really important chart. I think it's going to be a really important chart over the next year or two because I think it'll capture the net effect of all of these enforcement actions from a driver perspective. I can give you an update on October. We only have it through September. Our survey team just finished up October. It came in at 50, which is neutral on the index. So it did tick down from September, but it was actually in line with August. August was right at 50 as well, so we've had a few months now where you just call it roughly neutral. What I would say is, we're no longer loose, but we're not yet tight. And I think some of these enforcement actions are going to have an effect, pretty gradually over time. We're also going to have a supply of drivers, and I've had, I had some pushback on this, I'll admit, from people in the industry who say, yeah, private fleet driver is not going to accept a for-hire driver pay. And I'm like, well, if he has no other option, I think he might. And private fleets are starting to let drivers go. And so I think that is going to keep a little bit of upward pressure on this. Private fleet drivers do get paid quite a bit more. So it's going to be a pride swallowing event to go to but also, just generally speaking, current driver pay has gone up quite a bit since before the pandemic. We're giving up some of that in real terms because it's been pretty stagnant for the last couple of years while inflation has continued to go higher. But at the same time, overall driver pay is not terrible, and that's one of the reasons this is holding up. And I guess the last sort of real key point is if you look at 2018 and 2020 on this, those months where this index went below 40 was when the spot market took off. And And so watch this index for that 40 level. The 50 level is neutral, but we're surveying medium and large fleets primarily, and it's always a challenge for them to get drivers. It's always a tough thing. So put a little bit of a discount, and maybe 45 is neutral, not 50.
Right.
But there's a little bit of leeway there. But I do think this is generally going lower. And certainly the sort of the out migration that's begun this year is going to drive that.
Right. Okay, great. Thanks. I think we spent a lot of time now on the supply side. So let's flip over to demand conditions. This next slide is the Cass Freight Index for shipments, and it tracks the number of domestic freight shipments across all modes. That's truckload, LTL, and rail. So it gives us a timely view of volumes and how market trends connect to the broader economy. So, Tim, what does this tell us about expectations for demand?
Yeah, I mean, it tells us demand is still soft. It's hard to say that this is news, but it's but I guess what I'll say is what our expectation here is that we still haven't seen the full impact of the tariffs, and it's probably a good time to talk about the tariffs a little bit, because we with everything that's been going on, what has been a really big piece of the story this year hasn't really come up just yet in the conversation. So certainly, I think the way most industry participants have described the past year or so, and I'm just trying to as opposed to my experience, is just what I've heard at conferences recently and from a lot of fleets, is that we actually you can see it early in 25. There was actually some glimmers of hope of decent demand, but things have been put down relatively quickly since then, and the market has loosened again, and just there's been pre-tariff shipping activity, and that you can certainly see it in some modes like intermodal. International intermodal has been one place where freight volumes are up this year, and I actually think freight volumes are broadly growing a little bit in the U.S. economy. The reason that I think this has been down so much in the past 2 years in particular is this shift of freight from for-hire fleets back into private fleets, because private fleets have added so much capacity. If you go back to our first slide, a lot of those trucks that were bought in the past few years were private fleets, and I think that has that's one of the main reasons that for-hire shipments have been soft. But let's also break it down by mode, because for those astute readers who have paid attention to the Cass report the last few months, 2 out of the last 3 months, for the first time ever, we've pointed out the difference between a TL and LTL within the Cass index, and truckload has actually been positive in a couple of months, not the most recent month, but a lot of the declines that we're seeing are on the LTL side in particular, which is struggling in part because the manufacturing sector is not great, but there's also some insourcing going on there, and you've also got that overcapacity that continues to plague the truckload market. Basically says that marginal load that could go between truckload and LTL is going on a truckload these days, and that's pressuring the LTL market as well. And you got a lot of LTL shipments for every truckload. So this is probably understating the market a little bit, but definitely highlights how difficult things are out there, and yeah, we don't think it's going to really rebound strongly until the second half of 26. Now, just as the pre-tariff shipping was temporary, the paybacks on the downside, which are starting kind of now, are also going to be temporary, and so I do think there's still some more downside, but that should help lead to a recovery. But the main driver of the recovery, along with modest economic growth and a little bit lower interest rates, which eventually should kickstart housing a little bit, but a lot of the reason that we expect things to go from negative to positive next year is that reversal on those private fleets. And so while there's still some excess capacity there, eventually that will tighten up. We think that's 6 to 9 months out, and that'll lead to stronger demand for the for-hire market, because there's just going to be fewer private fleet trucks.
Yeah, I just want to make one comment in case this isn't clear for some of our listeners or viewers. But
Mhm.
Tim, you guys have been talking about the private fleet expansion for a couple years now, and I think we're one of the really prominent voices to kind of call out what was happening there. But what I think is really interesting is that when you think about private fleets, you're talking about trucks. You almost kind of would think that it's naturally a supply factor, but when it comes to the for hire market, it's very much a demand factor. Those loads that are going private fleet instead of to contract carriers and hitting the spot market and things like that, that is a volume reduction. That's a market share reduction that the for hire fleets are going to get exposed to. So any kind of reversals on, and I think I even made some pretty pointed comments, the last few times that we've spoken on camera about it, is just, I was on the shipper side back when, the COVID boom and rates occurred. And I think that there's probably was a lot of trauma from back in those days. People don't like when their CEOs and across America are all talking about freight costs on every quarterly earnings calls. And that perhaps some of that led to, hedging against movement in the for hire market, investing more in private fleets, seeking stability. But what comes with it is, significantly higher operating costs. I've seen some reports, I think maybe you have called this out too, is that it's like maybe $4 a mile today to operate a private fleet. Vastly
At least.
more expensive than owner operators or even just traditional for hire fleets.
Hmm. Yeah, no, and thank you for seeing the connection between supply and demand. I often feel like I go to a lot of investor conferences and they're saying, well, you need demand. It's not just supply. We talk a lot about supply, of course, but but they're interrelated, as you understand. So thank you.
Right.
And I'll just add one more kind of comment on the demand front. Yeah, there's a lot of obviously tons of conversation and headlines around interest rates and what's the Fed going to do.
Mhm.
And everybody kind of points to rate cuts to driving, just demand broadly and the economy and just the easing of the policy there. But one market in particular I want to highlight is the housing market. Construction in general is a huge component of domestic freight volumes. And the housing market being kind of stuck in the way that it has been for the last call it 3-4 years, I think has really contributed a lot to the volume sag that we've been kind of experiencing during that time. And just a couple points I'll mention on this. There's kind of a saying. It's like you buy the house, then you buy the things to put in the house, the car in the driveway. And the thought behind that is that those who are trying to be first-time homeowners can't quite afford it yet. They may be foregoing other, expenses and purchases and things like that, trying to save up for this really expensive house, that chasing the American dream, as they say, and all of that. So it can have a kind of a trickling effect or domino effect into other areas of the economy too. And we actually met with the head of the Birmingham branch of the Atlanta Fed last week, and he presented some data to us that I thought was really just interesting on this subject. So 90% of homeowners have mortgages below 7%. 70% of homeowners have mortgages below 4.5%. So a pretty significant amount of people with relatively affordable mortgage rates. And it's expensive to move, which I think kind of further contributes to locking up the housing market. So you've got a lot of different dynamics there in play that, and then the next piece of this is even while Fed rates have been cut here over recent months or over the last couple of years, the mortgage rates really haven't moved a ton. I mean, they're down off of the highs, which were probably around 8%, down to maybe like 6.5 today. And that's one thing that even the representative from the Fed mentioned. He's like, we've been cutting rates, but you haven't seen a lot of movement in 30-year mortgages. People kind of, I think, assume that everything moves in lockstep, but that's not the case. So there's a lot of talk about that. I do think the housing market is a huge piece of the puzzle for us, just in freight volumes domestically here. And I would mention kind of the one bright spot really has been on the AI data center front. Obviously you see the headlines on the hundreds of billions being invested into data centers. Seems like every week there's a new data center being announced, breaking ground. But that's one of the few bright spots, particularly from a construction standpoint, which is very, very limited kind of niche sector. Obviously, tons of capital flowing into it, but I do
Brett, and
think that the
that's
construction
all.
piece is a huge element here.
Brett, that's all great. I just want to make sure that we, get to the actual forecast here in a minute, and just trying to keep us on track. But I mean, I mean, a lot. I feel like there's even other things we haven't even touched on yet that are worthy of comment here. But as we just before we actually move into the forecast, I just want to take a step back for a second and just look at the full picture here of supply and demand. And this slide just kind of pulls together all the topics we've reviewed so far, from driver availability, CDL issuance, Class 8 truck sales, shipment volumes. So we can see how all these factors interact and set the stage for what's ahead. So on the supply side, we've looked at Class 8 truck orders, we looked at non-domiciled CDLs, we looked at ELP, driver availability, and then on demand side, we looked at 2026 volume expectations, touched on IEPA, which could be a huge conversation here, and before we know it. So we may touch on that here in just a second again. But the tariffs being something big that we're waiting on for the Supreme Court to rule. Private fleet impact on the for hire volumes, and again, that's going to be a big conversation in the coming months. Interest rates, housing, and construction. So, with all that being said and reviewed, let's finally just take a look here at the what's coming or what we expect here in the year ahead with the forecast. So, this slide is focused on the U.S. dry van spot rates, and it gives a clear view of where rates have been and where we believe they are headed. Tim, can you walk us through the trends and what the shippers and carriers should be watching for in the coming months, based off of our forecast here?
Absolutely. Thank you. Yeah. So we think short term, there's still some headwinds, right? We've had some pre-tariff shipping, like I talked about earlier, and that's fading a little bit as some of the pre-tariff activity has to pay back. That's the next few months. We think we're in a similar kind of a situation. We have seen well, it was a little tighter in terms of spot supply in the September-October timeframe. Things have certainly come back in November, even when things tend to tighten up a little bit into Thanksgiving here. Should tighten up a little bit, into year end, but we just don't think the market is overall tight yet, and we think that's still going to take a good bit of time. I'll sort of steal from the Q&A. There's a really good question about when do we expect the Supreme Court to rule on the tariffs, and that obviously will impact this forecast. And what the best I can say is as we do the forecast these days, we're using a lot of Bayesian probabilities. We don't know a lot more where these things are going to shake out. So we think there's actually a very good chance that the IEPA tariffs at this point do get removed. The U.S. Constitution is pretty clear. The Supreme Court justices were pretty clear in the oral arguments that they seem to intend to uphold the Constitution, which suggests that the IEPA tariffs are unlawful. So that's my opinion. I'm not a lawyer, but I think there's a very good chance that the IEPA tariffs go away. I think there's a lot of other Section 301, Section 232, other tariffs are going to stick, but the big ones, the reciprocal tariffs, the fentanyl tariffs, these, the U.S. Constitution is pretty clear that this kind of stuff needs to go through Congress. So they probably do go away. And I think that supports a recovery improves the freight demand outlook. It supports that recovery that we talked about earlier in terms of freight demand. And I think that'll drive spot rates higher at some point. But the question of when is one that it could happen tomorrow. It could also happen at the very end of the Supreme Court's term in June. So we just don't know.
And then I think there's also a question of what does it even look like after they rule. I think there's refunding some of the tariffs is a possibility, and I think we talked about that as a somewhat of a stimulus possibility. I mean, there's a lot of variables or unknowns out there that we just can't forecast quite yet. I think we're all I think a lot of people who are looking at these tariffs also agree with you on the IEPA will be overturned or the lower court upheld, however I want to say that, the IEEPA tariff will go away. There's still probably going to be some tariffs that remain after the fact, or after this ruling. But again, just depends on how that ruling is actually implemented after the ruling is made is a big question mark. So but that's definitely something. That's one of the other, at least on the demand side of the equation. I think that's one of the biggest things that we're all keeping an eye on is the Supreme Court. And I think that was a great question. So, Brett, anything else to mention there? I'm trying to give. We do have a couple more questions coming in.
I mean, two things. Just one on the timing of the tariffs. Tim, I think you put it as about as well as said as well as possible in the report of soon to June. I'm going to be stealing that one if I ever get that question. Just when we can expect some resolution from the court on that. I think the one other thing I'll just mention. Yeah, I do feel the sentiment that it's very hard to call for a lift in the market. It's kind of like a lot of people are in the mindset of I'll believe it when I see it. And the boy that cried wolf. We've seen other reports. Even before this of calling for inflation, even 24, 25, didn't really happen. And I just think that's probably if it doesn't even matter which side of the fence you're sitting on if you're a shipper or a carrier. And I know we have members from both of those communities here on this webinar with us, but there's either a hope or a fear that this shifts further out to the right. Tim, what do you think the odds are of this continuing to shift further out to the right from a forecasted lift standpoint?
Yeah, it's a good question. I think I think this is sort of the time where it's almost easy to lose conviction that this is going to happen because we've expected it for a couple of years and it hasn't happened. But I'll point out, in 23, we were pretty quick to say, hey, private fleets are growing. This is going to take a while. And then, this year we were pretty bearish when the trade war hit and we took our numbers down pretty quick. And there's definitely factors that could push this out to the right. Trade war getting worse, us being wrong about the IEEPA thing. There are definitely things that could push the economy into a recession. If we mishandle the Fed transition and lose independence there, that's a big thing our economists are concerned about. Now, I think base case is the economy continues to grow slowly, but we've got pretty good productivity. Private fleets have, that sector of the freight market's been growing for a while now. And I think overall, I do wonder sometimes if I'm a little too bearish on the next 6 months and things could happen a little faster too. I think there's a chance that if we do get this ruling, it's one of those really clear signals to the market, right? That I know some shippers are concerned about it, and I think that's fair. Most shippers I talked to are kind of budging 2 to 4% this year, and they're kind of saying, "Yeah, I said that last year too." So everyone's in the same boat. But I do think this year is different, and it goes back to our very first slide where truck sales are just much lower today, and the fleet's not getting bigger anymore; it's getting smaller.
And just one last word, just even to kind of like your point here, and this is one thing I've seen out kind of in the community is that there can't be a recovery without volume, without a demand lift. And history has shown that that's not necessarily true. Back in 2009, we actually saw demand in the broader economy going down, but saw a bull market in freight just through super accelerated bankruptcies on the trucking front and the diesel crunch back then. So there are precedents for a supply side recovery. I just want to call that out.
Yep, and we've got a few more questions. I just want to, we've got about 5 minutes left, so I want to try to get to these and kind of some of these dovetail in with our topic right now. One is it fair to say there are no expectations of growth in 2026 if tariffs stay as is?
Good question. Yeah, I think short answer, that's fair.
Yeah, definitely a headwind.
But that goes back to what Brett was saying. Does not necessarily mean there will not be a recovery in rates. I think what we've kind of discussed is the supply side is kind of facing a death by 1,000 cuts. You know, there's just so different things that are chipping away on the supply side. Demand is probably the biggest question mark, I think, out there. So
I think I would say the rate recovery that we have here would still not be quite as good. I think I would suggest what we're forecasting has some probability, not 100%, of course, but some probability that the tariffs go away. Yeah, and we already have. So the interesting thing on this is also that even after the oral arguments, they've already started cutting tariffs.
Yeah, right. That's true. Yeah. You've seen these little mini deals taking place ever since those arguments. The
writing's got them on the wall.
Yeah, I think so.
I think so too.
So another question. Can you speak on the flatbed market going into 2026?
Yeah. Flatbeds, I mean, it's a little bit, I think it's a little bit less of a premium than it normally is to dry van right now. It had been pretty strong into this fall. It's sort of a tale of two markets. Like there was a lot of strong flatbed project activity earlier this year, kind of pre-tariff stuff. Not the greatest construction environment, as we've already covered a bit. But yeah, flatbed is seasonally soft right now. And we don't think things are going to, pick up in a big way until the springtime, which is just a sort of a normal seasonal trend for flatbed. I think capacity is coming in there as well. I think it's obviously a bit more specialized than dry van. Well, I mean, reefer is as well, but we've certainly have spoken with some flatbed, some privately held for-hire fleets who are just frustrated with the profitability environment, like most fleets, and they're taking capacity down.
Yeah. Okay. I think I have time for one last question here. And maybe let me just see. If and when orders reaccelerate, have there historically been patterns as to whether owner-operators or larger fleets lead the way? I'm not sure. I think we're speaking of Class 8 truck orders.
Class 8s.
Yeah.
I can do that.
Yeah.
Yeah. Historically, owner-operators are not very big new truck buyers. Historically, they tend to be used truck buyers on the small side. Just frankly, it's the lower barrier to entry. New trucks are getting pretty expensive these days. So I think the big fleets, buy most of the trucks.
Yeah.
Yep. Yeah. So just to that point, like the owner operators are typically going to the used market to acquire trucks, which also has gone through kind of similar headwinds. Like the used truck prices have kind of cratered and things like that too. So a lot of dynamics there.
Yeah. Interestingly, on a low mileage used truck, prices have gone up this year because of the tariffs. But like day cabs and older and higher mileage stuff, still very soft.
Yep. That's a good point.
Great. Okay, so I think we've got about just a few seconds left here, and I think we actually did get to everyone's questions. But Tim, anything else? Any parting thoughts or anything from you for today?
I just want to thank you guys for having me. It's always good to talk with you, and thanks everyone for listening, and hopefully we had some good predictions for you.
Same here.
Always a pleasure, Tim.
Well, great. Well, yeah, thanks for joining us, Tim. And thanks everyone, all the listeners for joining us. Like as Tim said, we hope this was helpful and insightful. And, if you have any additional questions or something you'd like us to further elaborate on, then you've got my contact up here on the slide. So please feel free to reach out and we'd be happy to connect. And also we'll be sending a recording of today's session out next week to all everyone who's registered for the webinar. So thanks again for joining us and best of luck in 26.